Hello, everyone. Thank you so much for joining us today for our first quarter Lunch and Learn webinar. My name is Jeremy Cronemeyer. I'm the Operations Manager for Wickham Financial Group here. I'll be your host today for the call. I also have John Dickson here and Graham Wickham. Graham, I'll let you take it over.
Yeah, thank you, Jeremy, and thanks for all of our callers jumping on today. As you know, we like to do these lunch and learns. We're going to be moving them to a quarterly basis instead of a monthly basis. So just keep an eye out for notices on that. And we try to have these lunch and learns to be as timely as possible. We tend to focus, or we look to focus, not tend to focus, but we focus on total wealth management. And when we're talking about that, we're thinking about retirement planning. What's the cash flow needs? How long do you need it? The investments and the planning aspect of that. So, kind of what fuel do you put into your engine to get your retirement vehicle or planning vehicle down the road? Risk management strategies. How do we mitigate risk, transfer risk? Estate planning. We all have a will, a wish, and estate. How do we pass it on to the ones and things we care about? But most importantly, today, we're going to be focusing on tax strategies. How to keep more of what you work hard for, right? It's your legal obligation, right? To try to pay less taxes, but you got to pay what you owe, right? So we're excited about having John Dickson with Hensler, CPAs and advisors here to kind of give you some last minute tips and tricks for 2023 returns that are coming up, and maybe some additional thoughts for planning for the rest of 2024. So, John, I'll let you go ahead and take over at this particular point.
Great. Thanks, Graham. Appreciate it. Well, we thought we'd break it up into two different segments here. We're going to start out with individuals. These are some last minute tips and things you can do now to help save taxes on your 2023 tax filings. Businesses, we're due 3/15, your partnerships and S corps, and now you've got individuals that are coming up 4/15. So if you're going to file on time or extend, then you have till October 15th. But for individuals, things that you can do right now to save on taxes is your IRA contributions. So again, we work closely with Graham and his team with clients to help do these, to help implement these tax planning strategies. One thing to look at are IRA contributions. You can make the deductible contributions, which would then be, decrease your tax liability for 2023. Those contributions are due by April 15th. So you do have a little bit more time to make those contributions. For HSA contributions, you can also have until April 15th to make those. You have to have a high deductible insurance plan to make these contributions. And again, we work with the financial planners and Graham and his team. One thing we look at is when you make those HSA contributions, not to utilize them because they can grow tax-free. So it's kind of a way of self-insuring your future medical expenses or long-term care. So you can put in that contribution, use your cash flow to pay your medical expenses, and then let that HSA grow tax-free until your future needs. If you have expenses for those HSAs, you can maintain the documentation and pull it out at any point in the future. But again, looking at your financial plan and what you have available for the future, it's a way to help save for future expenses. Another thing you can do now to save for 2023 taxes are 529 contributions, specifically Georgia. Every state is different, but Georgia actually allows you to contribute by April 15th to take the deduction for the prior year. That contribution is limited to $4,000 for beneficiary if you're single, $8,000 if you're married filing joint. So you could fund $8,000 into a 529 Georgia plan and take that deduction for Georgia purposes. You could then turn around and distribute it out to pay expenses, or you can have it grow tax-free. Again, there is a lot of power in that growing tax-free for future use, or if you have it for primary or secondary expenses, you can take the distribution for that. Another thing you can actually do a super fund of the 529 plans. Graham, I know we've worked with some clients on doing that as well, when you can front end those 529 plans with 5 years worth of contributions to help it grow substantially before the time you need it for the college expenses. The tax law actually just changed. I know a lot of clients were concerned that they were overfunding 529 plans. What if my child doesn't go to college? What happens if they don't use it all? Not only can you change the beneficiary for those, now the IRS is allowing you to roll over up to $35,000 to a Roth IRA. So there are there are other things you can do other than just have to use it for college. You can actually roll it over, and we're still waiting on additional guidance. How many beneficiaries can you name on those 529 rollovers? But the funds have to stay in there over 10 years, and there's other things you have to qualify for to do it. But it gives some clients comfort to know that there are all other alternatives for those funds other than just spending on education. Something to look at from a planning perspective for individuals that a lot of clients miss out on is the retirement exclusion. This is a planning opportunity going forward. So this is something we look at from a planning perspective with Graham and his team to see if accounts are titled in a way to maximize your retirement exclusion. If you're 62 years or older, you can qualify for a $35,000 exclusion on retirement income. This also includes up to $4,000 earned income, but the other $31,000 can come from investments or retirement accounts. When you hit 65, that $35,000 goes to $65,000. So that's available for both taxpayer and spouse. But if you have a joint account, the income earned gets split 50-50. If you just have all the account if you have all your income in one account, then that taxpayer is getting the ability of that retirement exclusion. So in how those accounts are titled has an impact on your retirement exclusion. So you want to make sure you're maximizing your exclusion every year for Georgia. Something here recently that's become more popular with taxpayer are tax credits. This is a way to direct your tax dollars to an organization or group that you care about versus paying the Georgia Department of Revenue. So you can actually fund, Georgia has a rural hospital credit that you can actually send your tax dollars to a rural hospital, and then you get a tax credit, dollar for dollar. So a credit, if I send them $10,000, I get a credit for $10,000. They also have, a lot of people are familiar with the education expense credit. A lot of times that gets phased out, and so you're capped on how much you can do for that credit because it is based on an allocation of funding from the state. And once that funding gets capped, then you're limited on the amount you can take for that credit. They have the foster child donation credit as well as the qualified law enforcement donation credit. So these are actual local organizations within your neighborhood. Could be Kennesaw Police Department, could be Cobb County. So you can actually contribute to those groups and get a tax credit for that. So instead of writing Georgia Department of Revenue a check, you're writing it to a law enforcement group or a foster child group. So helps direct your tax dollars. Another tool we use when working with financial planners, especially Graham and his group, are Roth conversions. This is a great planning tool that we use a lot, and especially in a year of retirement or a year in low income, you actually convert your traditional IRA into a Roth. And the importance of that, as Graham can explain, is the power of the Roth. You might be paying taxes on it today, but the growth will actually exceed the tax dollars you're paying based on your time horizon for your investments. So have you, Graham, in the last 12 months, have you guys seen a lot of the Roth conversions?
It's definitely a conversation we try to have, right? Especially with the younger clients, or they have too much assets built up in the IRAs or the employer-sponsored plans. So we definitely are having those conversations on a pretty regular basis. I did have one question. We get this a lot. Should I lease a car or should I buy a car from a tax standpoint? What's your thoughts on that?
Well, I always go back and again talk to the client and getting with the financial advisor as well, because it's not just a tax question; it's also a financial question too. And we hear that similar questions like real estate and things like that. It becomes not just a tax question; it becomes a financial question. But As a business owner, there are tax benefits to buying a car versus leasing a car. You're going to get more of a deduction up front for buying a car. And there could be benefits from leasing from the purchase, even if you're financing it. There's other questions, not just are you buying the car, but are you going to finance it? What's the interest rate you can get? And then working with the financial advisor, what kind of rate of return are they getting on their portfolio versus what they're deducting on the interest that they're paying on the purchase, if they're financing it. So, I see most of the time the math works out that the client decides to purchase it, whether they're financing it or not financing it. Usually the lease works out more when it's someone who wants a different vehicle every few years. If you're somebody who you want that new car every 3 years, the lease is usually going to work out more favorable than the purchase option.
Right.
But you did mention the Roth conversions for the younger folks too. That reminded me the backdoor conversion. What they call the backdoor conversion. That's where you're contributing, to a traditional IRA, and then you're immediately turning around and converting it. That's with the IRA contribution. That's something you can still do now for 2023. You've got a few more weeks here where you can make your 2023, even if you don't qualify for the deductible contribution, you can make the non-deductible and then do a conversion. If you already have a IRA, there is a taxability of that based on a ratio if you already have an existing. But normally you can do the break-even point to see, based on assumptions, what my rate of return in, what's the tax savings, what's the benefit for that conversion. So,
right. I'd love for you to circle back to real estate. You briefly stated real estate because we get that question all the time. Hey, can I buy some real estate and save some taxes? And I know that's a conversation we've had multiple times. I'd love for you to expand on that.
Sure. Clients will come in and exactly, they'll say, hey, can I just buy real estate and save taxes? And unfortunately, there's tax laws prohibiting just writing off real estate. The passive loss rules are going to prohibit investors just from writing off losses. If you're a real estate professional, you have a whole different set of rules and tax laws that you can utilize. But just an investor investing in real estate, it's not just a tax question, it becomes an investment question. Is it a good investment? Because the tax benefits aren't necessarily going to be there for an investor as they would for a real estate professional.
Right. Great. Thank you.
So now for looking at businesses, for some last minute tax planning things you can do for 2023. You can still make retirement plan contributions, and you can actually still set up retirement plans depending on your organization and structure. There might be an opportunity for you if you're a sole practitioner. If you have a plan, you can. If you don't have a plan, you can still establish a plan for the prior year. Used to, you were limited on what plans you could establish in the following year. SEP IRAs are ones you could still do in the following year, but now you can actually do the 401ks in a year now for a prior year. So you have until the extended due date to do the contributions. So if you're an S corp, you extended, you have until 9/15 to do your contributions for solo 401ks, and for self-employed for the unicase. For SEP IRAs as well, you have until the extended due date. So you still have time to make those contributions. And this is a great way to save taxes on your prior year and use your current year income to fund those deductions. Retirement planning is, as we talk to clients all the time with Graham and his group, it's one of the best tax planning strategies, because you're literally taking money out of your left pocket, you're putting it in your right pocket, and you're taking a tax deduction for it. Most expenses for businesses, you're spending $1 to save your effective tax rate or your marginal tax rate. So if you're spending $1, you might be saving 40 cents. So just spending money is not a great tax planning strategy, because as a financial planner, you'd rather have the 60 cents than saving the 40 cents, right? So there's a lot of benefit from the retirement planning from a tax perspective and from an investing and financial planning standpoint.
John, and I'd love to add some additional color on that, you know, and I think for a lot of small business owners, maybe a sole proprietor or a husband and wife operation, it's often overlooked that that they can do like an individual 401k, a SEP, something like that, and be able to put in above and beyond just a regular IRA. So we do find that it's often overlooked, underappreciated, that they do have extra things that they can do above and beyond just an individual that doesn't have a business. So taking advantage of those employer plans for yourself, because you're not just the owner, you're also the employee of your own business. So.
Exactly, and I'd say a lot of clients will sometimes think, to keep the money in the business, my highest rate of returns in the business, I want to keep it in the business. Well, this is a way to carve money out of the business, take a tax deduction and invest it, and take some off the table. This is something we also talk to clients about don't just keep keep all your eggs in one basket, right? Just from an investment standpoint that you speak to clients with, from a tax strategy too. You want those different buckets, your taxable accounts, your tax deferred accounts, and your tax never accounts, right? So, and then as your business grows and cash flow grows, there's other alternatives you can do from a retirement planning standpoint as well. Cash balance plans, instead of tens of thousands of dollars, you're talking about hundreds of thousands of dollars into retirement. So there's other strategies along other than just SEP IRAs and 401ks that we could look at as well.
Yeah.
Other things that you can do for try to help save taxes for the prior year: reimbursement of expenses. Not uncommon for small businesses to commingle their accounts. A lot of times you'll see a business owner using their personal accounts to fund business taxes, and then when it comes to tax time, they forgot about those expenses when coming up with their loss for their income or loss for the year, their P&L. So making sure that you've captured all your expenses, you reimburse yourself for your home office deduction, your utilization of your personal vehicle, all these different things that might come up throughout the year as a business owner, as a small business owner, that you might not capture in your business account. You want to make sure you pick up those expenses, because again, record keeping is very important when it comes to small businesses, and making sure we're reporting what you mentioned, your fair share, and paying that tax. Another strategy is income shifting, by paying family members that might be in a lower tax bracket, looking at restructuring differently to move income from a higher tax bracket to a low tax bracket. Those are things that can be done even after the year. Even a lot of times clients during the year will do W-2s and do payroll, but then after the fact, you can always do 1099s. Of course, that's things you want to do before April 15th, because obviously that other taxpayer has a filing obligation for April 15th. So you want to be able to implement those before the upcoming tax deadline. Also, for businesses, something that's fairly new the last couple of years is the entity election. In Georgia, they allow you to pay your tax at the entity level instead of your individual. So in the past, your itemized tax deduction is limited to $10,000. So if your state income tax and real estate taxes and all your taxes are over $10,000, you're not getting a benefit for those. So a lot of states have implemented an entity election where you actually pay your business taxes at the partnership level or the S corp level, even though you're not a corp. So C corps pay taxes at the entity level. Everybody's familiar with that, but now they're allowing partnerships and S corps to pay their taxes at the entity and then take it as a deduction. So it's saving you your marginal tax rate in dollars. So if you're paying $10,000 in taxes that wouldn't have got a deduction individually, you're now saving $4,000 if you're at a 40% effective rate for federal and state. So it's a great way to save taxes. It's an election that's done every year. If you're a cash basis, you'd want to pay it in by the end of the year. So if you haven't done that entity election in the past, 24 is the year you want to start paying your estimates for your business in 24, and therefore deductive in 24. And then from a planning perspective too, you've got bonus depreciation and cost segregation studies. So those are things that you can help reduce your tax liability by taking advantage of different deductions. 179 is a way to accelerate depreciation from a tax perspective. Bonus depreciation is actually decreasing. And one of the recent tax proposals, they've proposed increasing it back to 100%, but in 2024, you're looking at only 60% bonus. Georgia doesn't adopt a bonus, so you still have an adjustment in Georgia. That's why most of our taxpayers were utilizing 179, as you mentioned before, the 179 with vehicles. Normally, that's what we see in Georgia, since Georgia doesn't allow bonus depreciation. One other thing I wanted to mention that we're seeing is a lot more popular here recently are donor advised funds. And I think even Schwab has offers now. They call it a charity account, or is that what it is, Graham?
It is, yeah.
A charity. So the donor advised fund allows you to contribute a lump sum amount and take that deduction in the current year that you contribute it, but then you can distribute it out to the nonprofits over a number of years. So if you're in a high income tax year, you made a lot of money, you're in a high tax bracket, you can give a lump sum and basically pre-fund your contributions for the next few years. Take the deduction now when you're in a high income year versus maybe in the next few years when you're in a lower tax bracket. Plus, it can be invested and grow, and so you're actually being able to give more to the charity over time than you would have otherwise.
Yeah, great tip.
Gotcha. Well, thank you, John. Thank you, Graham. I had a couple questions come in. I guess the first one, John, would be for you. It was, can I contribute to my 401k or my employer-sponsored plan, but also to an outside retirement account?
You can actually. You can contribute, and of course, you want to make sure you're maximizing your match at your employer 401k. But outside that, you can contribute to an IRA. There'd be some limitations on if it would be a deductible contribution, but you most certainly can. And even if you have a side business, you could potentially even have two 401ks. You wouldn't be able to do more than the annual deferral amount. There's a max deferral every year that with the catch up that you can contribute. But outside that, you could do a profit share. So you can actually contribute to multiple 401ks if you have a side business other than your employer plan. So you could have a solo 401k or a SEP IRA as well as a traditional IRA. So there are lots of opportunities to help contribute to your retirement.
But I think you said that you were still held to the annual maximum, right?
You are held to the annual maximum. So for the deferral amount, you would have the max deferral for the year, between all 401ks. So if you had multiple 401ks, if you fully funded your employer plan, then you wouldn't be able to defer any in your solo 401k. Right. But you could do a profit sharing to your solo 401k. So there's opportunities to do that, as well as your traditional IRA. Would still have the annual cap that you would be able to contribute, and depending on your age, whether or not you have a catch up. Same thing with the deferral. And that's one thing we see a lot of times with employer plans. Clients sometimes forget about maximizing that catch up amount.
Yeah. Great.
And what is that amount, John, for 2024?
For 2024, I believe it's $6,500 or $7,500. So for 2024, the catch up is $7,500 for 401ks. So for IRAs, I believe it's $1,000 catch up.
Right.
So $1,000 catch up for IRAs and $7,500 for 401ks.
Yeah. I think the ability to have your money compound without being taxed, potentially ever if it's a Roth situation, is so powerful over time. Because I think we all get so focused on the short term that we forget that there is more chapters than just today, hopefully in your book of life, right? So we want that stuff to spread out over time.
And that's why the income shifting can be so powerful for family members. If you have kids and you have a small business, you pay a child $7,000 to do odds and ends associated with the business, and you turn around and put it in a Roth, and it grows tax free for 20 years. I mean, there's a lot of power in that.
Yeah, absolutely.
Yeah. Well, Graham, I had another one actually for you. It came in. It says, how important is tax efficiency with your investment accounts?
Yeah, I think super important. I think, John, you touched on it real briefly, but, we don't necessarily know where taxes are going to be, exemptions, deductions down the road. So we want to think about tax efficiency. Something we talk about in our classes that I know many in our industry don't is, let's say you're trading, right? And you're trading in a taxable account, and anything under a year, John, right? They're going to pay ordinary income tax on the gains. Anything held over 12 months, you might have a lower rate on that from a long-term capital gains rate. So maybe just being more efficient on where, if you're a trader, maybe do that in your retirement account so you don't have to worry about, the additional taxes that you might owe. Also, what we think about from a tax efficiency is what is tax inefficient. So something like, say, a real estate investment trust might be taxed at your ordinary income rate. Maybe that's better in your retirement accounts and then in your taxable. There's no reason to continue to add to your tax liability when we can think about tax efficiency through maybe low turnover ratio mutual funds, maybe ETFs, individual stocks. Be mindful of the dividends that they pay out, because some, again, like the REITs, could be taxed at ordinary income rate instead of a dividend rate. So I didn't know if maybe you want to add a little more flavor onto that, John, but I think all these little things add up, and can add up to tens and hundreds of thousands of dollars over a lifetime.
I love introducing you to clients who have the tax exempt in their retirement accounts. Like, why is it tax exempt in your retirement account? It's like,
oh, a municipal bond?
Right. Yes.
Yeah. Scary when that happens, right?
Yeah. Right. Yeah.
I got you. Well, I had another question for you, Graham. It was kind of piggyback to that other one. If I'm seeking income, is there a tax efficient investment available?
Yeah, I mean, municipal bonds that we were just alluding to. I mean, that's one clear, interesting opportunity now, since interest rates went up so much. Usually bond values go down. Well, we're entering a phase that interest rates are going to start to be lowered. Now, how quick, how fast, that's up for debate. We'll just have to see. But that works in the opposite. So when interest rates start to lower, that can help appreciate or have appreciation in those investments. So municipal bonds, they're debt of municipalities. And if you buy debt of municipalities, which is generally very secure debt, you can double tax free. So if you think about it, you go out and you have a money market fund. And I know all of us haven't seen money market funds at these levels for so long. And let's just say it's 5%. Well, it's in your taxable account and you're at a high tax bracket. Probably most 50 plus are at your highest tax earning years, your highest tax rate, potentially. And are you really keeping 5%, right? You're really not. So you got to look at not just your gross return, but net at the end of the day, what you're keeping. But let's say you did a municipal bond. Now you're going to accept potentially more volatility and risk, but that could be double tax free. And if it's yielding 5%, you're keeping 5%, right? You buy that in the state that you reside in, that's federally and state tax exempt. So that can be a great vehicle to diversify your portfolio and be very tax efficient and take advantage of where interest rates are today, not just from an income level, but also when they start coming down, that usually positively affects bond values.
Gotcha. Well, we got about a minute left. Did you have any other questions for Graham for John, or John, did you have any questions for Graham?
We just talk amongst ourselves here, right? No, I think we're pretty good. I think, John, you really hit the nail on the head, covered a lot of information. And I know for clients that do want to receive this, we'll be happy to give them the slides. That's always available on our social media, on our website. You can always go back and reference these lunch and learns. We're just happy to have you here, John, here today, just talking about something that can be a little dry, can be a little boring, but it's important, right? This is money you worked hard for. Let's try to keep as much as you can, but pay out what you should, right?
Right. Not say, just piggyback on that and just say that, the planning is the important part. I mean, it's throughout the year. When you get down to April 15th, you should already know what your expectation will be, whether it's a small refund or whether you're going to be writing a check. The planning is so important throughout the year because it's easier to plan in the year than it is after the year. There's only a limited amount of things you could do when the year's over to try to decrease your tax liability and manage your tax liability. It's a lot easier if you're doing it throughout the year.
Again, planning, right?
Planning. Yeah.
Exactly.
Excellent.
Well, we appreciate it, guys. Thank you, John. Thank you, Graham. And like I said, our next webinar will be on the last Wednesday of June. So be on the lookout for that through our social media and through our emails. And we always appreciate it. And we'll see y'all next time. Thank you so much.
Great. Thank you.